You're watching the Money Show on ET Now, and let's get started with our first discussion. SIPs or systematic investment plan is one of the best ways to invest your hard-earned money in the equity markets. But when we talk about SIPs, usually the concept of SIP in mutual funds come to your mind. But SIPs in direct stocks are also gaining popularity these days. But remember, viewers, that SIPs in stocks and mutual funds are two different things and carry varying amounts of risk. So let's bring on board Arnav Pandya, founder at Moneyeduschool, to understand how mutual fund SIPs varies from stock SIPs and what should investors opt for and why. Thank you so much, Arnav, for giving your time to ET Now, and welcome on board. Firstly, because everybody who is not directly investing in the stock markets finds the SIP way quite convenient. So firstly, what's your take on the mutual fund SIP as well as stock SIP route, and how should one go about it in terms of the returns? What should be the expectation, and which one is a safer bet as for you?
So if you look at the basic term of systematic investing, the whole concept is that you put in an amount which is similar on a regular basis, with the end result that over a period of time, due to variations in the equity prices, you will get an average cost. Now, as far as mutual funds are concerned, we are very familiar with the entire SIP process, where every month, for example, you put in a specific amount and then you get units against this. But the main important factor when you do an SIP in a mutual fund is that you are getting exposure to a complete portfolio by investing in the units. So that is point number one. Now, the same thing when you try and replicate with respect to a stock, the basic concept remains the same, which is that every month, for example, you say, I will put aside a specific sum, and with that, instead of, say, a mutual fund unit, I am going to buy a particular stock. Now, the first difference that you will here see is that unlike a mutual fund, which can issue you units in decimal places and which will use up your entire money, you will need to do a proper calculation in terms of which stock you are buying and what is the price for it. Like, for example, say you are investing 5,000 rupees a month. Now, if the value of a stock price is, say, 2,200, what will happen is that you cannot buy a fractional stock in India. So you will have to buy 2 shares of that particular company, and 600 rupees will remain uninvested. So that adjustment you will need to make. That is the first thing. The second and most glaring difference that you will see is that instead of a diversified portfolio, when you do a stock SIP, you are getting exposure to just a single company. So there is no diversification, and your risk remain attached to what the company is doing and how it is performing. And the third thing which also you will find is that when it comes to a mutual fund SIP, you put it on automation mode. In a stock SIP, if you want to get that same kind of benefit, you will first of all need to have multiple stock SIPs to get a diversified portfolio. Second is that you need to do that effort every day, now every month, I mean. So now what you have a facility wherein your brokerage house itself gives you some facility to do an SIP. Still, you need to be very careful in terms of how you are going about it. So in terms of risk, there is a big difference. In terms of how your money is utilized, there is a big difference. And it's very clear that for a lay investor, in terms of process, the mutual fund SIP route is far easier than doing it on a stock.
Yes, Arnav, I totally get your take that for any new investor in the market, then SIP through the mutual fund route is quite easier and convenient to do. But Arnav, when it comes to stock SIPs, because when we host the query segment for the stock specific viewership, then they always ask that whether or not that on some stock where they are actually losing money currently, is this appropriate time to average this particular counter? If somebody has a long term view, then how should they go about with stock SIP? Because stocks are quite volatile, because that's just one particular counter where they are putting their money in comparison to a mutual fund where they are actually have exposure to a bunch of stocks. So when it comes to stock SIPs, how should one go about it? And if they are actually losing money in some of their long term bets, then how should they tackle that nervousness, if you can say? How should they play with that psychology and keep continuing with their SIP amount? What should be the strategy behind this?
So the first thing that any investor needs to do is differentiate between why they are doing the stock SIP. So stock SIP is not averaging out an investment just because the price has fallen. So there are two situations which investors face. See, one is where they've already made an investment, then they find that prices have gone down, but they think that the company is a good one, or they hope that the company is a good one and it will give them returns. So then they say that if that is the case, I will buy at a lower price, so my average cost comes down. That is a one-off thing. Now, when you are looking at a stock SIP, before making the investment itself, you are very clear that you want to build a particular amount of investment in that particular stock or company. And because you don't have the money upfront or you want to spread out the risk, what you will do is that maybe it will take you 1 year, 1.5 years, but slowly, every month by investing an equal amount, you will accumulate that amount with the hope that because you think this is a good long-term bet, then over the years, this amount which you have invested through the SIP will multiply over a long period of time. Now that should be the actual goal of doing the SIP. That because you have identified a very good company, you expect benefits to come over a longer period of time because the various plans or the way the company is running its business is going to do well. Then with that time frame of mind, you are going in and setting up a stock SIP. So this is not an opportunistic move that you are doing. This is a planned strategy, and your goal is to have a larger amount of shares which you have, because you do not know today. I mean, if you invest in any stock, whether over the next 3 months, 6 months, whether it will come down or whether it will go up. So, which is why the stock SIP will help you average out the cost, but the basis or the reason behind doing it has to be very clear, and it is a planned strategy.
Okay, Arnav, if somebody has to start with the stock SIPs, then between the large, mid, and small cap, if they are looking for any investment in the stock SIP route, then how should they go about it? Because a lot of investors actually find it difficult to go ahead and actually find a good stock where they can have this particular strategy. So any advice that what should be the stepping stones for this thing to start this journey?
So ideally, I mean, these kind of stock SIPs are more suitable for large cap stocks. And the reason behind this is that, see, large cap stocks as a rule are less volatile in that sense. That, I mean, it's not like that they are moving up 30-40%, then coming down 30-40%. So one, mostly large caps are the one where you believe that these companies, because they are in a specific business segment or they are in a particular sector which is likely to do well, they are market leaders in their space, they will do well, which is the reason which makes you want to go and buy the company, and which is why you have started doing the stock SIP. So that is the normal way in which you go about it. But in some cases, if your portfolio demands it, and if you are taking a mid cap exposure, then maybe even a stock SIP in that segment is also done. But overall, what an investor needs to do is that they need to be very clear of what kind of exposure they are having in their portfolio. And why is this important? Because it's not just about one single investment and whether it will do well or not. Anytime an investor is looking to invest, they need to have a portfolio outlook, and that portfolio outlook to take into consideration what is their exposure across various market caps, what is their exposure across sectors. It should not be that just because you feel that there is one company in one sector which is going to do well, you have started investing in that particular company only. So it has to be in balance in terms of the exposure, because how much of amount you put in a stock SIP is also important. How many companies you select for these kind of SIPs is also important. So all that needs to be taken into consideration by looking at your portfolio and the various exposures that we have. That will determine how you go about this process.
Understand. But Arnav, lastly, if I may ask that if somebody is looking to go ahead with both these routes, mutual fund SIPs as well as stock SIPs, then how can they place their money in terms of bifurcation? Can they just go ahead with a 50-50 ratio, or any advice? Because I understand that it's a very individual sort of a call. Depending on their risk profile, depending on their return expectation, as well as the goal they want to achieve with the investments. But as a thumb rule, anything that they can follow in these lines.
So as you said, obviously, I mean, how much you money allocate where depends on an individual's particular situation. But you have to understand one thing, that you should not be replicating it. Like for example, you have to select mutual funds to do an SIP when you can't do the same by investing in stocks. Like for example, say in many cases, you might already have an exposure to large caps through one way or the other. So if you want, say, a larger exposure and you to the mid cap segment, then maybe you will be doing a mutual fund SIP. On the other hand, if there are some investments which are not likely to be made possible by a mutual fund SIP, then you might want to go and do a stock SIP. Like for example, you might believe that one of uh, the large cap companies which you feel have a bigger potential, that is not adequately being invested into by the large cap or the flexi cap funds which you have. So if that exposure in those funds is extremely low or virtually not non-existent, then looking at that, you might want to do a stock SIP in that particular stock because you don't have an exposure to that in your portfolio. So this kind of balancing is required. The logic is that do not replicate what you already have.
Okay, Arnav, thank you so much for joining us today on ET Now and helping our viewers understand that what is the difference between mutual fund SIPs and stock SIPs, and how can they go about it, selecting one, what are the pros and cons. It was great having you on the channel. Thanks once again. But with this, short break in this edition of the Money Show. Don't go anywhere. We have one more interesting discussion lined up with Shweta Jain. So we will be right back, and you stay tuned with us.